Good morning. This is Horizon's Middle East and Africa, our top stories this morning. We have a deal. The U.S. and EU reach a trade agreement setting a lower than threatened 15% tariff on most goods, including cars. Meanwhile, Chinese and U.S. officials are about to meet in Sweden to extend their tariff truce beyond the mid-August deadline. We are live in Stockholm with the latest. And Israel says it is increasing aid distribution to Gaza as international outcry grows over hunger in the war-ravaged territory. Well, it has just gone 8 a.m. across the Emirates. I'm Shimona Versace in Dubai. A busy Monday morning to wake up to. So much news to digest. Of course, the big one being that the U.S. and EU have finally agreed to the terms of a trade deal in Scotland, out of all places in the world. So we're going to be spending some time in the show talking through the details of what was actually agreed to in that deal as we look ahead to those Stockholm discussions between the U.S. and China as well. So potentially momentous week on the trade front. But not just there. We've got a whole bunch of data to watch out for. Jobs report in the U.S. on Friday, that Fed meeting on Wednesday, so watch out for the communication, the signals coming through on the U.S. economy. And it's U.S. earnings week, so we get some big names reporting, including the likes of Amazon, Microsoft, and Meta. So another huge week coming up for markets. S&P futures leaning towards the green already, up 0.4%, getting close in cash terms to 6,400, yet another all-time record high for the U.S. Wall Street index. European markets, no surprise here. We are looking like we're going to open up more than 1%, so very strong open for European markets are signaled ahead. On back of that, the conclusion of that U.S.-EU trade deal and what that could mean for some individual sectors, particularly the auto industry. A big win there with a reprieve on the tariff rate, down to 15%. Euro inching higher and higher, just shy of 118, very close to the year-to-date highs. So strength in the euro continues versus the USD. And then oil also seeing a bit of love come in this morning on back of some of the de-escalations that we're seeing in trade tensions and the economic outlook. Switching over, I thought this one was fun to look at, just because there was so much noise the last couple of weeks about Powell's future. But look at this. At some point, the odds of Powell's dismissal this year reached, let's say, around 37-38% per prediction markets. After that hard hat construction meeting, whatever it was, outside the Fed headquarters last week, the odds have come down to 14%. Powell survives another day, and it really does look like we're going to be with him until the end of his term, May 2026. So that is what the markets are telling you. A fun chart to look at. All right, let's move on and check in on how markets in Asia are faring this morning. Avril Hong is in our Singapore studio. And Avril, is the positivity about Europe and the European-U.S. trade deal translating to some of these Asian markets today?
I think on the contrary, that's part of what's led to this underperformance on Asia stocks versus European futures. The assessment by investors might be that Europe, compared to most other countries, has gotten actually a better arrangement. That said, for Chinese stocks, they're expected to continue doing well as long as out of Stockholm we see this continuation of the US-China trade détente. But we also have chip stocks in focus. The drag today on the region's benchmark, which is flat, is advanced after it got downgraded by UBS to sell, and UBS is citing overheated share prices. So that plunge you saw of as much as 10% earlier in the session was the steepest since early April. The other chip stock or chip-related stock that we're watching in the Asia Pacific is that of Samsung. Before the trading day began, we got word of a major manufacturing deal with a global player. It was later disclosed that this was with Tesla, and this is something that Musk has also confirmed. So we're seeing green in Samsung stock, and those are the moves that we're tracking in the region today.
Yeah, big move for Samsung then, up 3.5%. And as you say, a big coup for them and potentially for Tesla as well. Avril Hong in Singapore, thank you so much. Right, on to the big story of the day, of the weekend. The U.S. and European Union have struck a trade deal imposing a 15% tariff on most EU exports, including cars. As part of the pact, the bloc will ramp up purchases of American energy and boost investment in the U.S., while sidestepping President Trump's threat of steeper levies.
We've reached a deal. It's a good deal for everybody, I believe. And I think you were saying this is probably the biggest deal ever reached in any capacity, trade or beyond trade.
It is.
It's a giant deal with lots of countries.
For more, let's bring in Bloomberg's Oliver Kirk. Well, Oliver, it's President Trump, so obviously there are going to be superlatives. It's not just a good deal, it's the best deal that's ever been reached. What is in this deal?
Yeah, so listen, we're going to spend a little bit of time here just to go through what we got from this deal between the EU and the United States in Scotland, as you mentioned there. So what the EU went into these negotiations hoping for was 0 for 0, 0% tariffs for 0% tariffs. What they ended up with was 0% tariffs for 15% tariffs. So the Trump administration can call this a big win. As far as the Europeans are concerned, this is materially lower than what was threatened by the end of this week. That was 30%, about half of the rate that would have kicked in automatically if you were to believe Trump's deadline on August the 1st. So this comes as a real sigh of relief. And to many of the corporate people that I've been talking to CEOs, when you read a lot of the research that's been put out there from the various houses that have looked at the impact on European stocks, and you saw that illustrated in the futures up more than 1%, this is a very sort of bullish case compared to what the alternatives were for much of the European sort of trade picture. So is 15% tariff is the baseline tariff. According to Ursula von der Leyen, that will also include things like semiconductors and the pharmaceutical sector. That, however, is not very clear from the Trump administration whether or not that is going to be the final tariff rate on pharmaceuticals, for example, because we're saying that they're still working on that Section 232 investigation. They may have other tariffs on another day. So that is something that is going to continue to rumble on into the forward. As far as the cars are concerned, we can say that 15% is quite a bit lower than many people were anticipating. They brought that down from 25% down to 15%. And that is going to be also in exchange for some other parts of this deal that you mentioned there, Jumana, which is the Europeans will buy more fossil fuels from the United States. $250 billion worth for the next 3 years. That is $750 billion worth of natural gas, oil, and those sorts of things. I should mention, again, as a footnote in that, currently the Germans, a large LNG sort of importer within Europe, they already buy 92% of their LNG from the United States. So the question is, how much space is there for additional sort of measures there? And I should just say this as a sort of final note of caution, though this is overall a sort of bullish outcome as far as the Europeans are concerned, and many of the leaders across Europe have sort of come out on Twitter to that effect, there is still the question of how changeable are these rates ultimately for a Trump administration that may want to achieve other policy goals in the future. You can see that question very much open on the question of pharmaceuticals, which maybe we've not heard the last word on.
Yeah, it's really interesting in these trade deals that what you're seeing increasingly is other elements are being wrapped in as well. You've got the energy deals, you've got the pledge to invest in the United States. Japan had that. So what the EU agreed to is similar in substance to what was agreed to with Japan. But let's talk about what could be agreed to at these U.S.-China talks here in Stockholm. Obviously, the U.S. officials are going to be there. Scott Bessent is going to be there meeting with some senior Chinese officials. Is there hope for a breakthrough this weekend?
So I don't think we'll get the final breakthrough here in those discussions between the United States and China. So that is a delegation that is going to be led by Treasury Secretary Scott Bessent. He'll be here over the next couple of hours, and he'll be meeting with the Vice Premier of China to discuss basically the path forward for Chinese and American trade. Remember, this will be their third meeting in about 3 months, so there's been intensive negotiations. And they brought those tariffs down from the United States, brought them down from 125% down to the 30%. That extension will expire on August the 12th. And that is what they're here to discuss, to get an extension on potentially that runway to have those conversations. We've heard from some Chinese press over the weekend saying that there's already a sort of 90-day truce that has already been sort of in the works, and that is basically what we're going to get from this meeting. But the real question is going to be going forward, where are they going to make progress in other questions of trade? There is a question of fossil fuels. Will Scott Bessent ask the Chinese and put a little bit of pressure on them to stop buying quite as much from Iran from the United States? There is the question of semiconductors. The U.S. has yielded on that to send some of those H-20 trips over to China in exchange for those rare earth metals that the Chinese basically monopolize on the global stage. And there are a lot of other issues. I mean, there's a question of TikTok, right? Trump says there's a U.S. buyer. China still needs to approve that. So these are all going to be parts of these complex mosaic of negotiations. And as you mentioned there, Jumana, it's not just trade. With the Trump administration, this is really sort of the way that they exert their pressure to get other policy goals across the line. And that's exactly what they're going to be doing here in Stockholm.
Excellent overview. Bloomberg's Oliver Kirk in Stockholm today. Thank you so much. Well, another big week coming up in terms of central banks. The Fed is widely expected to leave its benchmark rate unchanged on Wednesday as policymakers await more data showing the impact of tariffs. The Fed Chair Jerome Powell has been under intense pressure from President Trump and his allies to reduce borrowing costs. So discuss the upcoming week and more is Aarthi Chandrasekaran, head of asset management at Shuaa Capital. I actually want to start with the trade deal over the weekend. With EU-US finally reaching some form of a trade agreement, does that take a lot of uncertainty out of these markets?
You can say that because it's been a great week with respect to tariff and trade deals. But again, it's very early stages, Jumana, because you just have the broader and a generic framework. There are so many specific points that needs to be ironed out in the coming weeks. And there could be scope for disagreements as well. So I would still wait until everything pans out and we really strike something on paper agreed by both the terms.
Does the market actually care about the details? I mean, I'm not just saying this in a flippant way, but I mean, it seems as though the market just wants to see the headline that there has been an agreement in principle without really caring about what happens if there's follow-through or implementation afterwards.
That's the sad part. What the market is looking at is the trade deals are better than what we feared, and hence all the exuberance in the market. But then if you look at the tariff as such, you started the year with 2% effective tariff rate, and today you're at 16-17% effective tariff rate. That has to filter into the growth, probably in the second half of the year. So I think the second half of the year growth would be weaker because you have a baseline impact. Your first half has been front-loaded by a lot of goods. So your second half will be weaker and you have an actual tariff impact in the second half. So your growth is going to decelerate.
Yeah, okay. So that will likely impact European growth then coming into the second half of the year. Do you expect the rally that we're seeing, European futures are looking to open 1% higher? Do you expect that to be short-lived then?
Yes, European stocks rally would definitely be short-lived, and so is any kind of risk assets, right? Look at the U.S. markets, look at the credit spreads. No one is
but they're at the tights and they're at the highs.
Exactly. The high-yield spreads are the tightest since the global financial crisis. And because the credit markets is not even spooked by a possibility of a slower growth or a higher inflation, and spreads are the tightest. So you have some pockets of credit market which is kind of giving you a distressed level scenario. But overall, if you look at the loan universe and even the high yield universe, best performing from a total return perspective compared to investment grade, that tells you investors are willing to take the kind of risk they want to get.
Okay, so you seem pretty cautious on equities then and global equities. Do you not have a bit of FOMO because these markets keep going, especially in the US, they keep going from record to record to record, and earnings season so far has been pretty strong. You've had about 80% of the companies beat.
It's very frustrating. It's very frustrating to actually think
Thank
that,
you for being honest.
To think that, the next month there's some kind of the weakness will happen in the economic data. But time and again, you say economic data coming in okay-ish. Even you have one set of data weakening, you have the rest of the data getting stronger. The next month, this data actually recovers. So to be on the sidelines, it's definitely frustrating. But look at it from this point of view, the valuation is like 22.5 times earnings. And if you look at the earnings growth expectation by consensus, you're talking about 12 to 13% over the next 12 to 24 months when you have a effective tariff rate of 16%. Something is not actually adding up. So we still expect that something has to decelerate.
So I would say the pushback to that is you're actually seeing bigger growth rates than that in the big tech, mega cap tech stocks where it actually matters, right? We have a big week coming up, obviously, for Amazon, Meta, Microsoft. If those companies exhibit strong EPS growth, then maybe those valuations actually can be justified because so much of the performance of the S&P is stemming from those stocks.
I completely agree with you, but I think with respect to the mega tech, it's just not about the EPS growth, it's about the capex. Are they going to continue the kind of capex spending that they have done it before? And how much is it getting monetized? Are we getting it monetized to this year, next year, or 2 years from now? That actually matters. And of course, tariff will also have a lot of, there'll be a lot of questions about tariff around these numbers as well.
So the Fed and what the Fed does next is obviously a big question for investors as well. At the top of the show, I was saying that the odds of Powell being forcibly dismissed have now been removed. So, hopefully we can just move on from that and just assume that Fed is going to be in his term or stay in until the rest of his term ends in May 2026. But the market is still pricing in almost, let's say, around 40 basis points of rate cuts from now until the end of the year. Does the data warrant that price cut expectations? Because as of now, you could argue the data is surprising to the upside, and inflation has been holding in, if not, moving softly lower?
I think the key market risk is not Powell resigning. The key market risk is that it's very highly likely that we get just one cut or no cut materializing this year. And then you have to price out, the market has to price out the cut for 2025. Then the shift focuses to 2026, where you'll have a steep easing trajectory. Yeah. Mostly you have a new Fed leadership under the current Trump administration who will have a more dovish tilt. And that's how we
So where do you put your money then?
I guess, you can't really stay out of money, but you have to be in defensive stocks. You have to kind of diversify yourself. Credits are doing incredibly well, but we also like equities, but just try to diversify, try to take the exporters in the U.S., try to be in the domestic companies in the rest of the world.
Yeah. Great to chat to you, Aarthi, as always. Thanks for coming on. Aarthi Chandrasekaran, Head of Asset Management at Shuaa Capital. And coming up, Israel says it's increasing aid distribution to Gaza as international outcry grows over hunger in the Palestinian enclave. The details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Israel says it has resumed limited humanitarian aid to Gaza, easing restrictions over the weekend after a mounting global outcry over hunger in the enclave. The Israeli military says it has paused some operations to allow UN convoys in and restored power to a water desalination plant. This comes as UK Prime Minister Keir Starmer is set to meet President Trump in Scotland on Monday to discuss a lasting ceasefire in Gaza. Joining us now is Stuart Livingstone-Wallace, Bloomberg's executive editor for Middle East, North Africa and Russia. A lot of international pressure had been building on Israel to do something about the humanitarian crisis in Gaza, resume the passage of humanitarian aid. What do we know? What are the latest developments from the weekend in terms of what is being allowed in now?
So, there does seem to be a change of policy there, and we'll see how long it lasts because, as you know, we've been here several times before. So what we can see on the ground is airdrops going in, and we know that Israel did some, and then we had some coming in, I think, from Jordan as well.
The UAE also.
Yeah, and you have aid trucks coming in from both Egypt and Jordan, but I think all the aid groups unanimously are saying it's nowhere near enough. So definitely better than last week, but we're talking about a drop in the ocean relative to what's required. And remember, they're playing a lot of catch-up here because you have this total blockade for at least 2 or 3 months, and it's been a trickle since then. But as you say, the international pressure, I think, has got to the point where it sort of becomes indefensible not to try and do something.
Yeah. Is this going to have any bearings on the ceasefire discussions, which also collapsed towards the end of last week?
To some extent, but in terms of the actual impact on the ceasefire and the terms and conditions that both sides want, I can't see a change there. And we keep coming up against it again and again. There's this sort of insurmountable clash, I would say, between what Hamas is asking for and what Israel is asking for. I don't see any change in that, at least at the moment.
Yeah. Later today, the UK Prime Minister Keir Starmer is going to be meeting with President Trump to discuss trade deal, obviously, and amongst other things, they're going to be talking about Gaza. The UK Prime Minister is also under a lot of pressure now because of President Macron's decision last week to recognize Palestinian statehood. Right. The UK have not said anything to that effect, but he has said that he wants to work with President Trump on pushing for a lasting ceasefire. How much leverage, really, does the UK Prime Minister have? And also, how much leverage, in this instance, does the US have in terms of trying to procure that lasting ceasefire?
Yeah, so starting with the UK on the US, I would say next to none. Or at least I see no evidence whatsoever that there is any influence there. And then in terms of the second leg of that, which is the US influence on Bibi, that waxes and wanes. And it kind of depends on what's happening on the ground within Israel. And as you know, Netanyahu is in a more precarious position politically than he was, say, a couple of weeks ago. He's lost his majority, obviously, in the Knesset, and to some extent, he will have to respond I would suspect, with more thought to what's going on domestically than to the US pressure. That's not to say he ignores what the US is saying, but he's very sort of 50-50 about whether he's going to respond in a positive way to what he's being asked to do.
Yeah, and also the US seemed to be a little bit frustrated. And if you listen to the language that came out of Steve Witkoff when those ceasefire discussions broke down, he said he doesn't think that Hamas are acting in good faith or in a cooperative manner. So even the US are frustrated with how all this is going. Stuart, thank you very much. Stuart Livingstone-Wallace, Bloomberg's executive editor for Middle East, North Africa and Russia. Well, coming up, Citi's head of Sub-Saharan Africa tells us the region has a lot of growth potential, as well as what the drivers are. We get you more from that interview next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Citi's head of Sub-Saharan Africa believes U.S. tariffs will have little impact on the continent. Akin Dawodu spoke to us in Johannesburg about expectations for economic growth across Africa.
Our focus is longer term. We see beyond the cycle, whatever cycle this turns out to be in terms of the tariffs. And we believe that there's a lot of growth potential in Sub-Saharan Africa still. Despite the headwinds, despite the global challenges, we think a lot of African economic growth will be driven by demographics and domestic demand. And we think that is a factor that will trump, no pun intended, tariffs as a sort of a propulsive force for African economies.
Like what? What sort of deals are you looking at?
We're seeing, this year we've seen a lot of interest in different sorts of transactions. We were the best investment bank at Euro Money, for instance, last week. And that's because there's been a pipeline of deals. You saw a listing last month of Guarantee Trust Bank on the London Stock Exchange. It was the first listing on the London Stock Exchange by a Sub-Saharan African institution in 6 years, right? We've seen lots of interest in some sovereign activity in terms of accessing the debt capital markets that we've been part of. There are lots of others in the pipeline, different sorts of transactions, including from corporate issuers, syndicated facilities for the likes of Africell. So there are transactions happening, and we don't expect that to go away because of the tariffs. The pipeline, our pipeline, and I'm sure most banks will tell you this, is quite rich at the moment. So some stuff has happened, some stuff will happen in the second half of the year. So that gives us optimism about the near term.
Akin Dawodu, Citi's head of Sub-Saharan Africa, with Bloomberg's Jennifer Zabazaja. All right, let's take a quick look at equity markets. Take a look at those European futures signaling an open of plus 1% after news of that deal being agreed to between the EU and the US. But coming up, could space be a viable alternative location for building data centers? We discuss. This is Bloomberg. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. We have a deal. The U.S. and EU reach a trade agreement setting a lower than threatened 15% tariff on most goods, including cars. Meanwhile, Chinese and U.S. officials are about to meet in Sweden to extend their tariff truce beyond the mid-August deadline. And we are live in Shanghai, where the World AI Conference is underway. China's premier says the country will be leading the creation of an international AI organization, as he warns of an AI monopoly. It's just gone 8:30 a.m. across the Emirates. I'm Jumana Versace in Dubai. Well, lots of trade news, trade deals over the weekend. EU and the US have finally agreed to the terms of that trade agreement, bringing down the baseline tariff rate to 15% from the 30% that was floated a couple of weeks back. And of course, the August 1st deadline no longer exists. So good news, particularly for some of the individual European sectors, including autos, a bit of a win there, and pharmaceuticals, though some questions as to whether or not that sector is actually included. But the takeaway is very strong open. Looks like it's going to be for these European markets up more than 1%. You could get a record high for the DAX, that German index, which, by the way, is up something like 16% year to date already. S&P futures also leaning towards the green as well as we build on the record highs last week. 6,400 is where cash S&P is close to trading. So a big earnings week coming up. Some of the big tech names reporting: Amazon, Microsoft, Meta, some of the big names to watch out for. Euros, you can see, continues to gain some ground versus the USD, just shy of 118. So heading towards those year-to-date heights of about 118. And then Brent just shy of $69, up 0.4%, reacting to the positive trade news from the weekend. Switching over, because it is earnings week, one of the charts that caught my attention was just a look back on what we've had so far. And the fact that, oh no, this is a different one. I'm going to go back to this one. So this is actually the odds of Powell being dismissed this year. Remember, we had that very, I would say, impactful meeting between President Trump and Powell towards the end of the last week as Trump paid a visit to the Fed headquarters. But he did say some positive things about Powell then. And so the markets have brought down their estimates of whether Trump is going to be dismissing Powell this year to 14%. At one point, that was as high as 38%. So Powell's job safe for now. This is the chart that I was looking at. What percentage of companies for the S&P have beat so far? And you can see 83% have already beaten. And that tells you perhaps a lot about how well the earnings season is going, but also how low earnings estimates were going into earnings season. So 83%, it's been pretty strong. All right, let's move on and check in on how markets in Asia are faring. Avril Hong is in our Singapore studio. Avril.
Yeah, Jumana, we're seeing Asia stocks pretty flat today. The big movers are on one end. Advantis, the chip-related stock, is the drag on the region's benchmark, at one point falling as much as 10%. This is against the backdrop of UBS downgrading it to sell, citing overheated share prices. But keep in mind, for Japanese stocks overall, they had been taking a bit of a breather late last week following 2 sessions of really powerful gains against the backdrop of their trade deal with the US. Now, aside from that related stock, we are also watching Samsung, which has extended the 3+% gains, piling on 5% higher now. This is against the news that we got about its big manufacturing deal with Tesla. The idea is that it's going to be manufacturing these next generation chips for Tesla at an upcoming plant in Texas, and this is seen as beneficial for its underperforming foundries business. So those are the kind of stocks that we're watching in the region today. Jumana.
Yeah, nice one. Samsung up 5% now on that news. Avril Hong in Singapore, thank you. Now, Premier Li Qiang says China will lead the creation of an international AI organization to ensure the technology does not remain in the hands of a few nations. He made the announcement at the World Artificial Intelligence Conference in Shanghai. Bloomberg's Asia tech correspondent Annabelle Jewellers joins us, and she is there, right in the middle of all the action. Belle, just walk us through what China's trying to achieve with this AI conference. And is it not also recognition of the fact that they are very much in the race for AI domination themselves?
Yeah, that's right. I mean, certainly you can see here today just how far China is moving and how fast as well, because we're in a section, for instance, totally dedicated to humanoid robots, and really what other country in the world could put this on with this many entrants that are in the race. But as you said, we heard from Premier Li Qiang. He spoke on Saturday, and he very much focused on the role that China can play in AI governance around the world globally, and that is also speaking to the sort of competition that we see between the US and China. Li Qiang didn't directly address Washington in his speech, but there is that clear move now that we're seeing from both sides to dominate not just infrastructure, but also standards and governance, how that plays out as well.
Yeah, Belle, just before we came out to your segment, Avril was giving us a run through of markets. Samsung stock up 5% today in trading on news that they're going to be fabricating or making these chips for Tesla. How much of a coup is that for Samsung? I know you follow the chip maker closely.
Yeah, well, we know that Samsung's foundry business has faced a lot of hurdles. It's been criticised, for instance, for falling behind in high bandwidth memory in particular. That's an essential part of AI infrastructure that's needed. They've lost market share to SK Hynix, for instance. It's a much smaller semiconductor name. But, I think for any sort of Bloomberg reporter, having your scoop confirmed by Elon Musk on X has got to be one of your career highs. But that's exactly what happened this morning. We had the scoop that Samsung was looking to make Tesla AI chips in a deal that's worth $16.5 billion. It'll run until 2023. Elon Musk went on X to say that, yes, that is going to be what's happening. In particular, Samsung's going to be making the A16 chip for Tesla. That's what he's saying is an essential part of AI infrastructure as well. So it's a very big announcement, and you've seen that reflected again in the share price. I can see up more than 5% still in the session today. Again, given the challenges that the foundry businesses face, now this is certainly a customer that they've already had, but an expansion of that relationship.
Yep, and kudos to the Bloomberg journalist who broke that story. Bloomberg's Asia tech correspondent, Animal Jewelers in Shanghai. Also, have fun with the robots behind you. That was Annabelle live from China. All right, governments and companies worldwide are racing to build new data centers amid the AI boom. But these facilities are energy intensive and have significant environmental impact. A UN report says a typical AI data center consumes as much power as 100,000 homes, and the largest centers will use 20 times that. Now, one Abu Dhabi-based company is looking to space as an alternative location to build AI infrastructure. Joining us now is Shareef Al Romaithi, founder and CEO of Madari Space. Really good to have you with us. Okay, hang on a second. Just explain to us what this is about. And your ultimate purpose, I believe, is to build data centers not on Earth, not terrestrial data centers, but in space. How does that work?
That is correct, and thank you for hosting me. And it's a pleasure to be here to discuss a topic that is very dear to me. Madari Space is an Emirati company based in Abu Dhabi that aims at building data centers in low Earth orbit to address the exponential growth of data that is being generated both on Earth as well as in space.
Yeah.
If you look at the data that's being generated on Earth, to date, we have already exceeded 180 zettabytes of data across the entire globe of data centers. And as you know very well, data centers are very energy intensive. They're extremely harmful to the environment. In fact, they emit more carbon than the aviation industry, which is quite alarming, especially as we are seeing the rise in AI modeling and AI infrastructure. Going to space and placing data centers there gives us the opportunity to support the growth of data being generated both on Earth as well as in space in a sustainable and secure manner.
Yeah, I'm sure you've heard this word before, but it sounds like a bit of a moonshot idea. Excuse the pun. Yeah. Does the infrastructure allow for the build of these data centers up in space?
Well, first of all, I must address the significant improvements in the space industry. This would not have been possible, I would say, maybe 15 to 20 years ago. But today, with the reduced cost of launch services, now the price per kilogram to launch any product or technology into space has reduced dramatically. And by addressing the data center operations in low Earth orbit, we have the ability to de-risk the operations and use low Earth orbit as a testbed to mature our technology before we can advance into deeper space and tackle the cislunar economy.
What would be the comparative benefits of using a data center in low Earth orbit versus a terrestrial data center? Is it operational efficiency? Is it cost? Where is the benefit going to come from for the consumer?
Well, we are addressing multiple verticals when we're talking about data centers in space. First of all, by placing data centers in space, we are addressing the data that is being generated right at the source in space. By 2035, we will expect or forecast data to exceed 3,500 petabytes by sources such as Earth observation satellites and others. This data is all raw, unprocessed, that must be downstream to terrestrial data centers. So by placing data centers in space, we have the ability to store and process this data in space, enabling the data owners to make informed decisions in real time.
Yeah. And I guess it's less energy intensive simply because it's cooler?
Absolutely.
Am I thinking it through correctly?
Definitely.
Yeah, okay. So then ultimately, who is going to be the target base? Who is your target client? who would use this data?
So based on our verticals that we're planning to address, we are targeting Earth observation operators and other space operators who generate data in space.
Yeah.
We are addressing governments and big corporations with large data sets who would like to store their data in space in a secure and sustainable manner. I'll give you a good example of a European country, Estonia, which has a secondary data center in Luxembourg for security reasons. Should anything happen to their data centers in Estonia, they can revert to their data centers in Luxembourg, where they are back to life with no loss of any national sensitive and critical data. So this can be applied to various countries that view security as an issue. So we can store their sensitive and critical data in orbit.
So the company is still in R&D phase.
Absolutely.
When do you expect to launch?
We are working very closely with Mohammed bin Rashid Space Center, as well as the United Nations Office for Outer Space Affairs, for our first mission, which is planned for Q3 2026.
Yeah.
And this mission would allow us to demonstrate our technology by storing and processing data in low Earth orbit.
So we spend a lot of time in this program talking about the fact that UAE is making a big push into AI, into the infrastructure around AI, into data centers. Do you feel that being a company headquartered and based in the UAE is going to help you with your global ambitions, or does it hold you back because this is a relatively small country and it might be difficult for you to get, the scale that you would like to achieve?
Well, generally speaking, data centers in space has gained a lot of traction over the past 6 months. And being located in the UAE is quite advantageous for us, given the fact that we're getting tremendous support from the UAE Space Agency and other stakeholders across the country. This would allow us to advance our technology and reach a maturity level that would allow us to reach commercial operations very soon.
Yeah, so interesting. Shareef Al Romaithi, founder and CEO of Madari Space. It's not that often that I get to talk about space and artificial intelligence and data centers, so it's fun to marry all of those stories together. Well, for more of these stories, looking into the intersection of wealth and power in the region, sign up for our Mideast Money newsletter on Bloomberg.com. It comes out on Monday afternoons. And coming up, after months of skepticism, investors are piling into Nigerian bonds thanks to sweeping economic reforms under President Bola Tinubu. We'll get you the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Nigerian President Bola Tinubu's reforms are sparking the biggest bond rally in emerging markets. The West African nation's two-digit carry yields are being backed by increasing government revenue, slowing inflation, and a stable currency. For more, our Chief Africa correspondent Jennifer Zabazaja joins us from Johannesburg. Well, Jen, last week we were talking about the central bank meeting and the fact that inflation has started to move in the right direction, but it seems more broadly there has been a shift in investor sentiment towards Nigeria, and investors want to own the bonds. So what explains this change in mood?
Yeah, Jumana, this is quite a turnaround for President Bola Tinubu. I have to say, as somebody who was covering his election on the ground, this is something that many people didn't believe he would actually be able to achieve. But still, there is a bumpy path ahead. So you asked about really how we got here. If we take a look at some of the reforms that he instituted, quite a bit of pain. He immediately got rid of or suspended the central bank governor, Godwin Emefiele, who had been accused of multiple accusations. He also was able to do away with the multiple exchange rates of the Naira, helping to free float the Naira, which many investors had been asking for quite some time. And probably one of the biggest initiatives that he championed was doing away with 50-year-old fuel subsidies. This is something that investors had said for years needed to be done to help revive the Nigerian economy. These were things that he instituted quite quickly, not without pain, though, right? I mean, many Nigerians, if you spoke to them, the fuel price had gone up quite substantially. There were strike threats, threats of strikes from trade unions, and also because Nigeria had for so long, although it is an oil-producing country, had been importing oil for quite some time. So a lot of these reforms that Tinubu had instituted were things that investors had been asking for a while. It was pain in the first 2 years, but as you were just mentioning there, we're actually starting to see some green shoots in the economy, potentially then the positive trajectory that we're hearing from investors and analysts taking a look at this economy is actually on somewhat of a smoother path ahead.
Yeah, it's interesting. Earlier on in the show, we were speaking to a strategist, and she was commenting on the fact that EM credit spreads are trading so tight. So I guess then the follow-up question to this is this bond rally sustainable in Nigeria, or are there any broader risks that could derail this momentum now?
That's the real question, Jumana, and many investors are wondering, do the risks outweigh the positive sentiment that we're seeing here? Now, I guess we should note that you were mentioning the local currency bonds. We're seeing the Naira-denominated bonds actually extending their rally right now, which is very encouraging for a country that just a few years ago, investors were flocking away from some of these investments with actually an 8.6% total return in July. If we take a look at just the markets more broadly, the fact that we're actually seeing the Naira stabilize after 2024, which was incredibly volatile for the currency. I believe the 30-day historical volatility falling from 23%, in December down to about 4.6%. And so really many economists are taking a look at what is the path ahead now for this economy, especially after some of these reforms. Last week we were talking about the rebasing of the GDP. It's seeming like the economy and growth of the economy is slowing because, Nigeria is having to take a step back from years of an over-reliance on oil and gas exports. And so potentially, eventually, we'll start to see some of the risks leveling out a little bit and maybe at least a little bit of a balance with this economy and continuing to give some bullishness for investors to continue to pour in to some of these bonds. But a positive story for Nigeria, which is something we don't always get to cover.
Yeah, there's good momentum there. We just had the chart up comparing the performance of Nigerian local bonds versus South Africa, which of course is another one that we've been following closely. And it's 3 times as much almost this year. Jen, thank you so much for the reporting there. That was Jennifer Zabazaja, our Chief Africa Correspondent in Johannesburg. And coming up, a big week for European corporates as the results come through across banks, pharma, consumer, autos, and industrials. We'll take a look at what to expect next. This is Bloomberg. Well, it's a big week for European corporates, with results coming through across major sectors, including banks, pharma, and autos. Earnings are expected to show how companies are confronting uncertainty and tariff-fueled cost increases. Joining me now is Tim Craighead, Global Chief Content Officer and Research Director at Bloomberg Intelligence. Tim, a real treat to have you on our show. Thank you for joining us. Let's talk about the earnings season. How is EPS growth tracking so far? Are there any sectors that are standing out for you?
Yeah, so thus far, if I look at what our European strategists have assessed, we're running at about 3.7% earnings declines for mid-year earnings. Expectations for closer to a 5% drop. So bottom line is earnings so far are tracking a bit ahead of expectation. Now you have to put that into context. Earnings expectations have been dropping like a stone over the course of the past 6 months because of tariff and trade and all those concerns that have been mounting. So it's a low bar, but so far we're seeing some positive results.
Yeah, I mean, positive compared to real negative expectations, whereas in the U.S., you actually are getting positive EPS growth and positive surprises. How much of the T word is coming up? Tariff impacts, especially in the auto space, for example, which, by the way, it looks like they're getting a reprieve from now onwards.
Indeed. So it's coming up a lot. If we look at 90 companies that have reported thus far, again, I'm relying on Laurent Dulay and Katie Meng's work. It's fantastic. It's out this morning. It's interesting. You've got about a quarter of the companies that have mentioned trade and tariffs in their earnings transcripts, talking about trade disruptions. So it's a chunk. There's another quarter that are talking about customer intentions being impacted. So that's roughly half of the companies that are seeing problems in one form or another, challenges in one form or another. There's roughly 20% who think that they can offset by price. And there's another 20-odd% that are looking for various ways to mitigate. So it's coming up a lot. There's various strategies. Autos clearly are one of those that we expect this week, with all the companies coming out to give us an awful lot of perspective.
Yeah, well, talk to us about banks. We had BNP last week, Lloyds as well, Deutsche Bank, very strong results. This week we got Barclays, UBS, HSBC, Santander. What's on slate?
Yeah, it's interesting with the banks, Jumana, because here we're coming to what our banks analysts think is the tail end of a 4-year earnings upgrade cycle. You know, we've had positive rate environment, okay economy, and right now you're seeing the reverse of this. So from a traditional commercial banking perspective, we're expecting to see, less good, more of a challenge. That said, trading for somebody like a Deutsche Bank, as we've seen, has been quite good. So that could translate into good news for Barclays. Asset flows and some developments in China are going to be important for HSBC and Standard Chartered.
Yeah, nice one. And Tim, remind us, where can we get the Bloomberg Intelligence Research?
Yeah, absolutely. BI Go. And for the strategy work, look at BI space STOXE, stocks E.
Perfect. I'm going to use that a lot this week. Thank you, Tim Craighead. Well, now to finish the news on a high, England retained the Women's European Championship after beating Spain in a dramatic penalty shootout on Sunday. Chloe Kelly scored the winning penalty to claim victory for England. That was it for our show.